let's get a discussion going in the potential opening up of the insurance sector and the pension space. We've got Mr. G.V.Nageswara Rao, Managing Director and CEO of IDBI Federal Life Insurance, joining us in our studios. Mr. Rao, thanks very much. Good morning. Great to have you with us here. Santosh Singh is Banks and Financials Analyst at Espirito Santo Securities. He's also with us. Santosh, good morning. Good to have you here. Mr. Rao, let's start with you. What would 49% limit in insurance mean for companies in India?
It would fulfill the long-standing demand of the life insurance industry for allowing a higher FDI limit into the companies. So how much of the investments would flow into the industry would of course depend on the nature of the company and the stage of its development. Because if you look at the industry, out of the total number of insurance companies that are there, so the older companies have completed nearly 10 years. And the newer companies are about 4 or 5 years old. And especially if you look at the older companies, so they have reached a stage where their additional capital consumption is going to be quite low. Most of them would be looking to become self-sufficient in capital. And therefore, so I don't really expect that opening up of the FDI would lead to greater capital inflows into these companies and therefore, of course, the bulk of the industry. But what you would expect to see is that many of the domestic players may be looking to dilute their stake and sell their stake to the foreign investors, and that could bring in FDI.
New players, or what players?
I'm talking about existing companies, because where there are domestic companies who are shareholders as well, who are the majority shareholders today, and some of them could be looking at exiting or diluting their stake and allowing their foreign partner to increase their stake. And FDI could flow in through that method, where the foreign investor could be buying from the domestic investor. So I would expect to see much larger inflow of FDI through that method rather than additional capital.
So basically change in shareholding patterns. The foreign investor, foreign partner picking up a little bit more from the Indian partner, that kind of stuff.
Yes.
And why do you think that will happen? I mean, what's the logic behind it? The Indian partners want out of the business, want lesser of the business, they want money. What's the logic behind that?
You see, there are different types of domestic investors. There are companies, especially banks, who have deep pockets, and they have so long-term interest in being in the life insurance industry, and so these kind of players perhaps may not like to dilute. But at the same time, there are also other types of investors, typically corporate investors, who could be looking at this opportunity to dilute their stake, who may not necessarily have so long-term interest in being in life insurance, and and they could really be looking to use this opportunity to give a greater stake to their foreign investor.
So broadly, what I take away is that banks might want to remain where they are in terms of their shareholding, etc. But corporate investors might, in some cases, decide to dilute in favor of foreign partner.
Yeah, as a broad statement.
That's a broad statement.
Yes, but it would vary from company to company. Obviously.
Yeah. What we also understand, Mr. Rao, is that because of the stated opposition of parties like the BJP of going beyond 26% FDI,
right?
The government might introduce 26 FDI, 23 come via the foreign investor route, foreign institutional investor route. What's the basic difference, first of all? I mean, how does it matter?
See, FDI is where there is a foreign insurance company typically, who comes in as a strategic investor into an insurance company, whereas in the case of FII, it is typically a portfolio investment, which is usually made in a listed company. And if the government chooses to go the path of allowing a higher limit for FIIs, that is a different way of bringing in foreign capital into the insurance industry. But I think that would really become effective when the companies list. As you know, none of the insurance companies are listed today, and the current regulation requires.
But you've got businesses listed, which you've got a large portion of their business as insurance. I mean, you've got lots of companies, right?
Yes, their parent companies are typically listed, but we are talking about increasing the FII limit in the insurance company as such. Because
that won't be possible unless the companies are directly listed, entities are directly listed.
Unless the company is directly listed. And the current regulation requires the insurance company to complete 10 years of operation before they can list. And not only that, they need to have a 3-year profit record. And therefore, that the number of companies which would become eligible to go for public offerings and list themselves is quite small. And not only that, the market conditions perhaps are not very favorable right now. Therefore, it will take some time for companies to list. and therefore so if the FII limit is increased, it is certainly useful, so especially for those companies which are planning to get listing. But I think effective flows we will see in due course. So when
only after these companies are able to list.
Yes.
And how far out is that according to you? When will we start seeing that? I mean, at least the beginning of companies starting to list.
It's anybody's guess. There are a few companies which are preparing themselves for a public offer and list, and I think it is really a function of the market conditions also. And but I would really expect to see in the next couple of years at least some companies list.
Couple of years means 2 years.
Yes.
Okay.